Well, hello, everyone, and welcome to the Oil and Gas Retirement Workshop webinar. I'm Kerry Facer, and alongside me is Len Hanson. Len, are you here?
I'm here.
Very good. We will be hosting tonight's workshop webinar, so thank you for attending, and let's get started. If you would like a copy of our ADV disclosure information about our firm, please give us a call at the number there, 714-876-6200. So tonight we are going to cover these 6 steps for a successful retirement. We have 30 minutes with you. This is the first part of a longer series that we'll be starting in preparation of getting back to in-person live events as we used to do for years together, our team with Len in the past. And so tonight you can cross number 1 off. Congratulations, you are done with the first one. You're here, so you've attended a workshop. Next, we are going to go right into the retirement handbook. Before we do, hopefully everybody knows this guy, Drew Carey. Welcome to the stock market where everything's made up and the points don't matter. Sometimes it does feel like that, but I imagine some of our clients or prospective clients that are here listening are hiring or training new people at the refinery, and they probably have no idea who this guy is. But I love Drew Carey, and I even know someone who didn't know who Bob Barker was. A true story. Anyways, thank you for joining us. Let's get started. So this is Warren Street, the entire team. We actually have one more person we just hired. So we are growing thanks to our clients and thanks to all the introductions you've made for us. Len Hanson there in the light blue jacket, third from the right, and myself in the center left there with the dark blue jacket on that I did not wear again like I did last time. So I avoided that mistake. We will be presenting tonight. If you have any questions, please know we're a true ensemble. What that means is that Len is our expert for anything Chevron related to oil and gas, and specifically in the El Segundo area. But we do have a depth of expertise here. We have 4 certified financial planners on our team, 1 CFA and another studying for his level 2 CFA. So if there's a question you have, we probably have an answer. If we don't, we will work as a team to figure it out. So a few months back, Len shared with us that he was getting a lot of people asking him about retiring. And a few of them were 51, 2, 3, 4, 5, and Len was sharing with them all, you really want to wait until age 55. There's a lot of reasons, one of them which is the rule of 52. But Len, kind of catch everybody up to speed. What have you been hearing at Chevron? What's going on? Why are people reaching out to you, who aren't yet 55 but want to retire?
Well, some of it is some of it are people in their mid 50s, not quite 55, reaching out thinking that they're ready to retire. Just reaching out to find out if it makes sense for them to retire, if they have enough money, and what other issues that they're not thinking about. But then I also have a lot of late 40s, early 50s people thinking that there might be just a couple of years out from retirement. And then I got to break down the rule 55, which I think a lot of people at Chevron know this. I've been talking about it for, I can't even remember how long. I actually retired at 55. The 55 rule allows you to separate from service from Chevron. You have to separate from service at 55, the year you turn 55, actually. And you're allowed to take distributions from your 401k. It's got to come from your 401k, and take distributions and pay, your normal federal and state tax, but you're not going to pay the typical penalty of 10% federal, and then I think states got a penalty also. I think it might be as much as 2%.
Mm-hmm.
And that is what you would typically have to pay if you, quit and quit at 54. You'd have to pay those penalties all the way up. There are other ways around it. They're not really usually very good tools. The 72T is another way you can get to your money if you retired maybe before 55, but it's not really a good tool unless you've saved a lot of money. So it's a great tool if you want to retire early.
And Len, remind everybody, for some who don't know you, but you worked at for Chevron for 33 years and 24 at the refinery?
Yeah, 33 years total. I worked in San Pedro Marine Terminal. They closed that down in the 90s, and I moved to the refinery in the early 90s and worked there for 24 years. The last 9 years I was in planning, basically planning the gasoline, jet, and diesel blends, and working with the crude coming into the refinery.
And
So
then how did you get involved in helping people manage their 401ks? Where did that come from?
well, that I actually had a broker's license. I got a stockbroker's license. Thought about leaving Chevron in the 90s.
Mm-hmm.
Loved the stock market and got a license. Did that part time while I was working at Chevron, and essentially started. People started to realize I knew how the 401k worked. I knew everything, all the ins and outs of the 401k, and I started helping people that I work with. Basically, they'd log into their plan, and I would show them, help them pick mutual funds, and that started to spread around the refinery. And I started going around the refinery off hours, not on hours, off hours, and go around.
You're
and help
retired
people.
now. They can't
Yeah.
hurt you.
Yeah. So I'd go just all over the refinery. I was going around helping people line up their 401k, get them in position, diversify. A lot of people thought they, had to buy Chevron stock, which isn't true. Today, at one point, you had to buy some Chevron stock through the plan.
Mm-hmm.
Now you don't even have to buy any Chevron stock. You can put your 2%, which is your basic 2%. You get the 8% match. You can put it in any of the mutual funds and the core funds, and you're not required to buy any Chevron stock. So I know a lot of people are, a lot of people in the refinery either mostly Chevron or a big portion is Chevron, and they think that they have to buy the stock. You don't have to do that. I can tell you that right now.
Right. So Len, where everybody listening, what Len's saying is he's been there, at Chevron, was there for 33 years total, and understands investing, understands the 401k options. And Len, traditionally, when clients do retire from Chevron, these are calls that you were on with them, talking to what used to be Vanguard, now Fidelity. Is that right?
Just made a call this morning with a recent retiree from Chevron, and so I'm doing this several times a month. Know all the ins and outs of how to order order that transfer.
Mm-hmm.
We haven't talked about ESOP shares. Those are different shares within the plan that you most everyone has it, unless you've only been at the refinery for maybe less than 12 years. You have ESOP shares, and they're tax advantage shares. Too much to talk about on this, but if you,
it's worth noting for anybody listening. Len's been doing retirement workshops for years now, and obviously with the global pandemic, it's been a little difficult. So we're doing this version for him to share with you what he's learned. We're going to spend 30 minutes together. We've got another 20 minutes, so I'll blow through some slides here. But the point of this is we're going to share with you what we've learned over the years. I'm one of the founding partners of Warren Street Wealth Advisors, and I've worked with Len now for about 11 years. And what we want to share with you is what he's learned through all these years. And then at the end of the meeting is you can book some time. It's a free complimentary consultation to talk to Len about your specific situation, ask questions about what it is you may be having a difficult time navigating, whether it's just cash flow, debt, ESOP shares, estate planning, taxes, whatever it is that we help our clients with. So let's start with the handbook. So Len helped put this handbook together years ago, and it still holds true. It's have a plan, seriously have a plan. Make sure your timing is correct. So Len, I think one of the things a lot of people ask is, when should I retire? What's the sweet spot to retire from Chevron?
Well, the sweet spot is when you have enough money to earn.
Sorry, time of year. If you have enough money, you have a plan and you're ready to go.
Yeah. Okay. Now I understand where we're going with this. Basically, so this time of year, it's late in the year. If nobody's retiring right now, obviously that's on this webinar, but I'm sure everybody knows that how the vacation works. If you were planning on retiring in December, it might make sense. And we've actually had a few people thinking about doing this. And what we convinced them to do was stay until January, because the way the vacation works, if you work in whatever years you have, like for instance, you have a six weeks vacation after 30 years, you can actually take that vacation in 2022 and take that entire 6 weeks at the beginning of the year and get paid for that, and then go ahead and vacation. You're only allowed to take what you've accrued. So if for instance, if you thought you could take that with you, maybe get paid out for that it doesn't work that way. You're paid for whatever you accrue. So let's say you work into March. You want to work into March. You got to work at least till March 1st, I think, before you can actually get paid out for a quarter of your vacation time. So what we can talk more about that. I don't want to go spend too much time on that, except for letting you know that there are rules around vacation and when to go out. There's some decision making to do. Don't just go out and at the end of the year in December and go, I'm just tired of this. There's some reasons not to do that.
Good. So get your timing correct. You have questions about that, talk to us, talk to Len. Retiring early, Len talked about this earlier. You're 57, you want to retire. One of the biggest things to know here is the Fidelity plan, Len, will let you take distributions directly from the 401k plan, meaning if you don't want to do a 72T and you don't want to do a 55 rule final distribution, but you want to leave your money in your 401k for a period of time, maybe to get you to 59 and a half, just take money directly from the 401k. Is that right?
Right. So the way the 55 rule works is you can take distributions from the 401k. So you're going to need to leave some money in the 401k to take the distributions, because if you roll that money over into an IRA, it becomes 59 and a half before you can take distributions without penalties. So the 55 rule is basically leave money in the 401k, take those distributions directly from the 401k, and you're not penalized for those distributions. Then once you turn 59 and a half, you can roll that over into an IRA, and then there's no penalties beyond 59 and a half. So that's typically how we do it. When somebody wants to leave before 59 and a half, we leave a little money at the 401k, maybe roll over the pension, and just leave enough in the 401k to get them until they're 59 and a half, and maybe a little bit of a cushion just in case something happens. And then when they turn 59 and a half, we roll the rest over.
So number 5, budget for medical expenses. This one's straightforward. This is one that's going to come out of your paycheck, but will now come out of your your personal lifestyle. So it's going to be one item on the toolkit, which we just shared in the chat, that the budget, when you're budgeting for retirement, you say you need $6,000 a month. Don't forget to add back in for medical expenses. Goodbye to credit card debt. Straightforward. If you got credit card debt and you've got cash saved up, pay it off. There's no sense of carrying credit card debt into retirement. So one of the things we see, it's not that often, but some clients will talk to us who have credit card debt and they're trying to figure out how to retire. Do not carry any debt into retirement. It's time to pay it off. And then that will help you build up that 6 months emergency reserves if you don't have it already. So whatever your lifestyle is from your budget and what you want for retirement, as I mentioned just a moment ago, $6,000 a month. If that's your lifestyle and you need $6,000 cash after taxes take home, just simple math, a basket of cash, and there's $6,000 in it, shows up every 30 days. Then in that example, you'd want $36,000 cash on hand. Maybe it's not all cash on hand. Savings and checking could be CDs, could be a high interest savings account, some sort of short-term paper just to provide a little bit more than 0% in the bank. Then that's our goal, is to see that cushion in retirement and before transitioning into retirement. Build and keep a budget. Here's one that none of our clients like doing. Len, you wanted to add something?
No.
Oh,
Sorry.
I thought you were gonna. I thought you flagged me there. So build and keep a budget is a lot of our clients don't like completing the budget. The link we shared in the chat, if you go to our website, and get on our oil and gas resources page, we have a tool there you can use, which is the toolkit, and there's a budget template. Our goal is to spend about 15 minutes on it, fill it out quickly, and the important thing is to actually take some action from that budget, which is find something on there that bothers you, such as, I don't know, maybe a phone bill or consolidating a first and a second on a home, or just refinancing the home. But find something on there that bothers you and take action to reduce that expense or to eliminate it. Weigh our Social Security options. Len and I were talking about this a couple of days ago, and he said he was comfortable sharing this. So I'm not trying to put you on the spot, Len, but just because you can take it at 62 doesn't mean you need to. A lot of our clients who are healthy at 62 are taking it at 66 or 67. It's important to know that you can defer and you get an 8% annual increase every single year, all the way up until age 70. Some of our clients say, no way, they don't want to wait that long. But then there are some who do. Len, you care to share with everybody when you plan on taking it?
Yeah, my current plan right now is to wait till 70, and I want to take full advantage of those raises. I probably won't need the money. I could choose to start it anytime after 62. So my plan is 70, and the reason for that is it optimizes my Social Security amount, and that continues with my wife will continue to get that amount for the rest of her life. She's a little bit younger than me, and healthier than me, so she's probably going to live a long life, and I want her to have as much as possible. And we probably most likely don't need the money, before then. So that's my plan.
Yeah.
And I think I said I was going to live to 100, and living to 100, I'll get my money back in 10 times over.
Yeah, I think the math shows it's right around 10 years if you wait till age 70 to when you'll start receiving more money. And
Right.
Don't hold me to that, everybody, but it's close. And the important thing is, when we run calculations for our client, is to share with you some options, allow you to see the dollar amount difference between 62 or say 67 and 70, and help you make an informed decision based on your health, and kind of your overall trust in the paying ability of the Social Security retirement benefit. Investor retirement number 10, max out your 401k. There. If you are not maxing out your 401k, probably a good time to do it. You're probably at your highest earning potential. Your tax deductions are going away, meaning kids are have moved out of the home. Your mortgage interest deduction has gone away. And one easy way to pick up a tax break is to max out your 401k. Len reminded me before we started today was to not forget to talk about after-tax contributions. So Len, how does that work? If I'm maxing out my 401k, I'm doing the max. It's going to be $1,000 more this year coming up, but 20,500. I'm doing catch up. What else can I do?
So there's actually a much higher limit than most people think for somebody, and I think it's gone up $1,000. The max total for the plan is $55,000 a year if you're under 50, and then it's 60. I think it might be 64,000 for over 50. And what that means is you can max out pre-tax or with an max out in a Roth 401k, and then beyond that, you can, between the Chevron contribution that you get, you can actually put a total of, like I said, 55,000 if you're under 50 into the plan. And that after-tax money, once it goes in, could be rolled out of the plan and into a Roth IRA. So if you have a lot extra money, maybe possibly have two jobs, I don't know, wife works, and you want to max out the plan and put a bunch of money in a Roth IRA, which we haven't talked much about that, but we can talk about that if you want to call me.
Mega Roth, backdoor Roth. That's an easy way to do it. Mm-hmm.
Yeah, we've talked about that on some of our webinars.
Yep.
But yeah, that's something. It's a little more complicated, so I can help you understand that if you want to reach out. But yeah,
it's a good point. If you've got that 6 months emergency reserves and you're looking for extra places to save, it's one of the most tax advantaged ways to do it. Is fill up that additional money beyond your personal deferral and your catch up. You pick up deferral on that, and if you do the timing right, say once a year before you have a bunch of gains, you could roll that money into a Roth IRA. I like that.
Right.
So if you want to learn more about that, talk to Len. And finally, invest for retirement. We talked about all those items, but one thing that is on here that Len is always doing or talking to our clients about is the ESOP shares and moving those over in kind at retirement. through net unrealized appreciation, just another tax advantaged way to move Chevron stock with very low cost basis to take advantage of capital gains rates as opposed to ordinary income on that one.
Mhm.
And again, as we said 2 times already, have a plan, but seriously, have a plan. Social Security, like Len talked about, it makes sense to defer if that is, if you're healthy at 62, every month you wait, you get an additional increase in benefit, 8% a year. So if you can wait, all the way up to full retirement age, which is 66 or 67. But again, just to reiterate, you can wait all the way until age 70 and pick up those 8% annual increases should you feel comfortable enough doing it. And like I said earlier, is we like to show you some options. That way you can see the dollar amount for each. And if it's a difference of $20,000 or $30,000 over retirement, that's a lot of money to pick up, and could be possibly a lot more. But it is a little bit of a risk, and we understand our clients might not feel as comfortable doing it if they have any major medical or health issues at 62. Then it may make sense to take it early. And back to, is it going away? I don't think so. I have some fears. I think a lot of our clients have fears, but I think they'll fix it a few ways, which is increase taxes, defer the date, or reduce the amount you get, or some combination of all three. It's traditionally, that's how we help clients prepare for retirement, right? Save more, defer the date. Instead of $6,000 a month, is $5,700 a month enough? And if you can do those same things for Social Security, I think you could do the same for you. And that's really how we help, keep that pot of cash around longer. So the retirement toolkit, again, this is a resource you make available. 15 minutes on each. Just jot down all the assets, all the liabilities, to be able to see everything you have in one place. And you can compare that to how much you need. And so if you look at your retirement budget here, we just put in some placeholders here to give you, some ideas of some things that could be on here that you could work towards. But if you spent 15 minutes filling this out and you think you need $6,000 a month, as we mentioned before as an example, and you can compare that to the assets you have to produce that income against the debt that you have that needs to be serviced, it allows you to quickly see where you are today. So if you were going to meet with one of our advisors, you're going to meet with Len and talk about retiring, we suggest starting with this as an easy step to be prepared for a meeting like that and transitioning into retirement. So balance sheet and a budget. Vision, what are you going to do with your new time? This is one thing a lot of clients forget to think about, is now that you're retired, what are you going to do with that extra time you have? The 40, 50, 60 hours a week between getting ready, the commute, if you are commuting, and not having to work anymore. And so we want to remind our clients to try to find what they've been saving all this money for. And hopefully it's one of these. And if you want to move out of state, we can support that. We can work in all 50 states. There's no issues there. But please keep in mind that the 2 most important things we see as determining factors of what state our clients move to is based around relationships, so their family and friends, and weather. What is the weather like? So a lot of our clients who are leaving California it's no surprise, are going to Texas, Arizona, Nevada, Idaho, Washington State, even far east is Pennsylvania, Florida, Tennessee. And while some of those states are tax friendly, please travel there during the winter time to experience the winter months, because being here in Southern California, we're all very spoiled with warm winters. And so we'd encourage you to even rent before you own if you wanted to move out of state to try it out. Len, anything on that, on moving out of state? No,
I think you covered it pretty well. Yeah.
Okay. Yeah, it's the same there. So we love helping clients plan for that. We have lots of clients that do move out of state. In fact, Len and I don't know, maybe 2.5, 3 years ago, went out to Texas to visit with some clients who just moved there to help them transition. And so if you do move to a state, please pick one that is not on that's on our to-do list to travel to. We'd love to come see you. Now, Len went to a retirement planning workshop about, I don't know, what was that, Len, 15 years ago? And I won't say whose workshop it was. But Len was there and said, what do you charge? And they did this song and dance about how they charge for planning or fees. And it did not sound right. And traditionally, when you can't get a clear answer, it's because that advisor works on commission. So their investments come with hidden commissions that are traditionally pretty high. So what we recommend you do is work with an advisor that works on fee. And so a percentage of assets is the most common. And on the right-hand side here, and I apologize, someone told us in a replay, if you're watching this, that our heads covered the fees. So the first one is 1%. The next one on the next million is 0.9%. After that, 0.75 and 0.6 for 5 million, and then 10 million and up 0.3. We do have a program called Friends and Family. So you get group bundled pricing. A lot of our clients who are retiring from Chevron are referred to us. And if you are referred to us, talk to us about the Friends and Family pricing for further discounts. Reason we came up with this is we're a small team of 11, and we want to compete with the Vanguards and the Fidelities and some of the others that are offering discount services. And this was one way we're able to do it. And if you just want a financial plan, we can talk to you about building a plan only, no investments. But please note they do start around $2,500, and that's something we can talk to you specifically one-on-one about pricing for you. Planning, there's 6 steps, 1 through 6 right here. First call would be free, complimentary retirement consultation, and that would be with Len. And then if you do decide to move forward on a financial plan, we'd go through full discovery, put a plan together, come up with all solutions, and then we'd spend a year with you to implement those solutions. And we do a year because a lot of the things we do take time, such as retirement, right? Maybe refinancing the house, or you need an introduction to an estate planning attorney to update your will, medical directive, durable power of attorney, or you maybe just don't have any of those documents yet, and we want to help see that through. On the back end of our planning, we can do a pretty good job at telling you if you're on track, off track in a first call, like, yeah, things sound pretty good, or maybe do these 2 or 3 things to improve your situation. But please know we do rely on data. So when we do build a plan for a client, we put everything in, and we will share with you what things look like and whether you're on track or off track. And then on investing, same thing. We have 3 structured portfolios we build to blend for clients, all the way from stock portfolio to real assets. And then we have fixed income or bonds in the middle there. And we'll build you a portfolio that's customized to your goals, objectives, risk tolerance, and time horizon, all the way from super low risk to high risk. In regards to risk, I want to stress something here. A lot of our clients come to us with all Chevron stock or a lot of Chevron stock. And so on the very bottom here is the dark blue is Chevron stock. And this has shown a total return of 28.8% over the last 5 years, compared to a balanced portfolio in gray here, which is all world index, which is US stocks, international, and emerging markets, 60% blend of stocks and 40% of total return bonds. So 60-40, a balanced portfolio, most likely what most of our clients would be in if they were retired, a 60-40 blend, some combination similar to that. And you can see that Chevron stock has not even performed as well as a 60-40 blend over the last 5 years. Now, the top one is the S&P 500. So a couple things to think about here. If you're going to own all Chevron because you think it's a good stock to own, and you're going to carry that much risk, you might as well own the S&P 500. It outperforms, and it has a similar risk profile, meaning all stocks, but you're not just one company, you're 500 companies. Now, realistically, we wouldn't recommend that for someone who's getting ready to retire. That's a pretty risky posture to have. But maybe you're listening to this and you're in your 20s or 30s and you're just starting out, and you really want to have some big returns and you have time on your side, then the S&P 500 would be a good way at finding that exposure if you're willing to stomach the risk. And then how does this look on tenure? Well, a balanced portfolio still outperforms on the 10-year number, Chevron stock. Total return 67.9% on Chevron stock compared to 86.6% in a balanced portfolio. And of course, the S&P 500 has outperformed both over the last 10 years. And the idea here with these bottom 2 is it's like, if you're going to get to the same destination and actually still get there with a little bit more return, why not take that smoother ride? So that gray line, again, the balanced portfolio 60-40 compared to Chevron stock, I mean, if you want to retire in 2000, obviously this is the global pandemic. That's a tough number to stomach, your retirement. So talk to us if you have a lot of Chevron stock, if you want to figure out how to build a new 401k that's ready for retirement. And finally, number 6, retire and enjoy all life has to offer. We are opening it up for questions, but because we're out of time and I don't see any questions left that we have not already answered, we are going to wrap it up. So if you want to get a hold of us, there's a few ways to do it. You can go to our website, warrenstreetwealth.com. There is a big schedule button. You can click on that and find a picture of Len Hanson, and you can schedule that first complimentary consultation for free. You can also call our main line. A real person will answer. Just tell them you want to schedule some time with Len Hanson, talk about retirement. And finally, if you want to send us an email, you can do so. For those listening to the live event or the replay, please note we are coming back to do events in person again in El Segundo. We have the first one, a tentative hold date for mid-February. So once we finalize that date, we'd love to have you come to a live event. We are going to continue to do these webinars and live events. So please look forward to more dates. And with that, I'm going to wrap it up. Len, before we do, any closing thoughts from you?
I think we covered it. I think we're pushing the time. So yeah, this is great.
Yep. Yeah. So
I
we're
think
right
I
up on the
talked too
time
much
here.
already.
Yeah, no, we're good. We nailed it in 30 minutes. So thank you everybody for attending. Again, Carrie Facer here with Len Hanson from Warren Street Wealth Advisors. If you want to attend again, please do so. And we hope to see you at one of our live events, or reach out and get a hold of us. We're happy to help you plan for retirement. So thank you for attending, and we will talk to you soon. Good night.